So now we are moving to the third speaker on the panel, Edward Bowles. He is a former member of parliament and also served as chief economist advisor and economic secretary to the Treasury. And importantly, he is one of the early advocates of Bank of England independence. So Ed, we are very happy to hear your thoughts on the current situation, particularly with respect to central banks' independence. Please.
Thanks so much indeed, Ekaterina. Can you all hear and see me okay?
Yes.
Yes.
Great. Thanks to Angus and Gary for organising the meeting. Even if it's not quite the event we all envisaged when we signed up for this a few weeks ago, Angus and Gary have asked us to look at the case for central bank independence in the light of the aftermath of the financial crisis and the current coronavirus pandemic, and in particular, in this session, to look at the issue of accountability. What sense should central banks be independent? What kind of accountability do we need to treasuries, parliaments, and to the wider public? It's a pleasure to follow Martin and Panicos. I hope my remarks will be complimentary. I'm going to come at this from an overtly political economy perspective as a former cabinet minister and government treasury advisor, and as Ekaterina said, the vested interest in operational independence of the Bank of England continuing to be seen as a successful reform. But I'm going to argue that these are uncertain, dangerous, febrile times, dangerous for the idea of independence. After a decade in which the idea of central bank independence has been increasingly challenged, Panicos hinted at this from left and right by economic experts, by some disillusioned citizens, also by some populist politicians. Also a difficult time as we enter what the new governor of the Bank of England has called a national economic emergency in the UK, and of course the same thing is true across the world. I think there is a lot at stake, not only in the continuing political acceptability of central bank independence, but wider public confidence in and support for, more widely, our current economic policy institutions. I should say at the outset, I'm confident, certainly here in the UK, that our leaders in the Bank of England and the Treasury do understand the issues and the risks. I think I agree with Martin. The relationship between the elected government and our operational independent central bank has in recent weeks been functioning well, I would say much better than in Eurozone in the last couple of weeks. But that doesn't mean these issues are going to be easy to solve. As I said, there has already, even pre this crisis, been some fracturing of the consensus in favour of central bank independence, from economists arguing that in a low inflation, low interest rate era, the case for independence is much less important, much less powerful. And some commentators fearing that the accumulation of new powers in financial policy and macroprudential policy, central bankers has gone too far, has made them insufficiently accountable. From some central bank woodsmen worrying that this broadening of the central bank remit is leading to excessive accountability and undermining independence. From some savers worrying that quantitative easy and unconventional interventions have had unfair distributional consequences. And more generally, as Panicos highlighted, from populist politicians arguing that independent central bankers are yet another example of the expert elite rigging things for them and their friends and against the interest of the people. And I should say it's that last group that I fear the most in America, actually when it comes to central banking, maybe in Germany too, as well as the UK. But this is my starting point. For those of us who were there when, in the UK, central bank independence first rose to the top of the political agenda, in the UK's case now, 23 years ago, the biggest surprise, I guess, is that the consensus in favour has lasted so long so far and been so robust. We certainly weren't confident that would be the case when the new Chancellor Gordon Brown made the announcement straight after the election in '97 to give operational independence to the Bank of England to set interest rates to meet the government's inflation target. And I think in order to understand some of the risks in the last decade and the risks now, it's instructive to look back a bit at that decision in a little more detail to understand why it worked and where the stresses were, because I want to do that looking back at the history and then apply that to the more current environment. It's no surprise when you look back that previous British Prime Ministers pre-97, Margaret Thatcher and John Major, were sceptical about the case for bank independence. But it was not because of the simplistic, I would say, textbook idea that this was all about short-term politicians wanting to be able to continue to cheat suckered voters with unsustainable booms. I'm not going to say there aren't politicians around the world who have tried to play faster than loose, but I've never met a British politician who thought engineering unsustainable booms was a good idea, and many have seen their careers undermined by such booms happening anyway. Nigel Lawson is a good example of somebody whose career was undermined by an unsustainable boom, and as a result became a great champion of central bank independence. Now, I think that the pre-97, the Thatcher major worry, shared by actually Chancellor Ken Clarke, was that voters expected, it was that they believed voters expected elected politicians to make vital decisions about things which mattered to them, about their mortgage rates in particular. They feared voters would be suspicious about city-based central bank experts taking control and, maybe not making decisions in the national interest. Well, it sounds familiar in that populist context. But on the other side, if the idea of the boom-bust-loving politician is a myth, so I think is the opposite cynical view. Independence was advocated by politicians who just wanted somebody else to blame. For Labour in 97, there were lots of advantages to embracing independence. A huge credibility statement of intent on stability and economic competence, avoiding another damaging, debilitating, highly personalised, rolling row with the governor of the Bank of England, which had made life very difficult for Labour governments in the 20s and in the 1960s. We looked at the Ken and Eddie Chancellor-Governor relationship pre-97 with sort of horror and fear. There were other advantages to us in going for independence, not all of which were clear at the outset. Going for central bank independence removed at the stroke a historic tension between the Prime Minister and the Chancellor over interest rates. We in New Labour found other sources of tension to replace it with, but it did take away that interest rate tension. It hugely strengthened the Treasury's hand on fiscal and wider economic policy, because we could always play the Bank of England argument. We could say to the Prime Minister, we could do that, Prime Minister, but I don't know how the independent Bank of England will react. I mean, it could lead to higher interest rates. One thing we knew from the outset, though, was we were never going to dodge the blame. If the new Monetary Policy Committee made mistakes, we would get it in the neck. We needed to know that in a crisis, the elected government would be in the lead, but also we were always going to share responsibility. That is why we went for operational independence with the Chancellor setting and regularly reconfirming the inflation target. And I think it was very important in passing that the inflation target was symmetric, that it wasn't 2% or 2.5% or less. We wanted a clear non-deflationary target and same challenging voices in the meeting. Hence, we appointed from the Treasury external members into the Monetary Policy Committee. Interestingly, I argued this in a recent Harvard paper, not only did over time that form of operational independence, as Stan Fisher defined it back in 1994, become the main international model, ECB being the exception for kind of complex reasons. Actually, it was championed, has been championed increasingly, not just by the Bank of England, but by central bankers more widely. I think the clarity of accountability of the government setting the objective and then giving operational independence to use interest rates to meet that goal has lots of attractions from a central banker point of view as well. Interestingly, while this is forgotten now, actually back at the beginning, Bank of England independence got quite a bumpy start. So much so that in September of 1998, the year after independence, following a series of interest rate hikes, with the economy slowing fast, with choppy global waters following the Russian default, with central bank independence being questioned in the media, the governor of the Bank of England took the unprecedented step, going to the TUC, the trade union annual conference, to reassure workers that he and the Bank of England cared as much about jobs low inflation. There was no southern bias, no London bias. They cared about growth in every region of the country, and low inflation is key to delivering that balanced growth across the country. That first year was actually the low point. What we then saw in the years which followed, support the Bank of England independence growing and growing. And I think I'd like to highlight 4 reasons why that happened, all of which were in the context of a late 1990s, early 2000s economy. First, clear and equal treatment. Both the goal, the inflation target, and the instrument, the interest rate, were clear and applied to everyone, young or old, north or south. Clearly changing interest rates had different distributional impacts. But the MPC was not in the game of making first-order distributional choices. It set one interest rate for everybody. Second, competent activism. From the outset, the MPC, the Bank of England, was far more active in their pursuit of the inflation target, raising rates month by month, then cutting them again and again and again post LTCM, far more active than previous chancellors had been, could have been. I think historically, raising or cutting interest rates month after month sparked political crises. It didn't for the Bank of England. It was credibility enhancing. And that activism, there's no doubt, was made more possible by having a symmetric target. An asymmetric 2% or less target would undoubtedly have strengthened those people within the committee arguing for the delay of key moments. Third, transparent clarity. Combination of that symmetric target, published votes and minutes, the open letter system if the inflation went off target, and a progressively better communications strategy. Far better, I think, than the ECB was at the start, maybe now. All those things were vital in building public confidence. The public regularly heard the Bank of England and MPC members and liked it. And then fourth, effective coordination. But all the fears that independence meant an inevitable tension between monetary and fiscal policy, that turned out in that period not to be the case. Partly because transparency and public minutes meant that any dispute would inevitably, damagingly to the government, be in the public domain very quickly. The Bank of England would explain that its rate rises were happening in the context of changing fiscal conditions, but actually, mainly in that period, monetary and fiscal policy were playing very different roles. Monetary policy was the prime counter-cyclical lever. Fiscal policy was more medium-term, focused on sustainability, but with the automatic stabilisers generally pushing in the same direction as monetary policy. Of course, that was then. Martin made his point earlier. That was then. That was a very different environment. The global financial crisis then posed a new and huge challenges. In the early part of the financial crisis, especially in the September of 2007, there were public tensions between the Bank of England and the Treasury about roles and responsibilities. The Treasury prevailed. In a crisis, the government balance sheet has to take the lead. And the Bank of England moved into a vital but supportive role, consistent, I would argue, with its responsibility to meet a symmetric inflation target, also to its wider responsibility to maintain stability of the wider financial system. With that flexibility made possible by operational rather than full independence for the mandate to evolve. I think Alan Blinder wrote a good paper a few years ago at Jackson Hole about how in crises, the nature of the Treasury Bank independence inevitably changes, whatever is written down in the law. That flexibility made it more easy by operational independence ensured that central bank independence emerged at the end of the crisis, the inflation target just about intact. I wouldn't, this is an interesting conversation to have later, I wouldn't call this mission creep. I think it was the economic context in the financial context which changed in the financial crisis, not the underlying goals of operational independence, but clearly the bank has to become more flexible in its view about its responsibility towards the inflation target. However, as I said at the outset, the aftermath of the financial crisis has posed growing challenges. I'm not apportioning blame here. The world just became much more complex. But to go back to those 4 points: clear and equal treatment, competent activism, transparent clarity, effective coordination. On the first, on financial stability, there has since the financial crisis, clearly been mission creep, as Panica said. The expansion of the central banker toolkit into macroprudential policy, which has happened in Europe and in the UK, to a lesser extent in the US, but also it clearly draws independent central banks into making decisions which, unlike with interest rates, have first-order distribution implications, more akin to fiscal, to monetary policy decision-making. Central banks, in the UK's case, in the Financial Policy Committee, making deliberately discriminating decisions about measures which impact both the cost and availability of credit to different types of borrowers differently. And then clearly many people believe that QE has also had differential impacts on different types of savings. So the simplicity of the single interest rate is not so simple. Secondly, competent activism on financial stability. Post-financial crisis, jury is clearly still out. But in a world of persistently low inflation and interest rates, of course, in this decade, the last decade, counter-cyclical flexibility available to central bankers has been vastly reduced. It's still being used, but clearly the zero lower bound has loomed in people's thinking. Transparent clarity was my third. I would argue here that in the UK case, certainly, adding an ill-defined financial stability objective to the inflation target and establishing a financial policy committee alongside the monetary policy committee to meet that objective has made transparency harder and decision-making opaquer. I agree with Panicus here. In the UK, the minutes of the Financial Policy Committee are much less scrutinised than the MPC. Votes are not recorded. Parliamentary scrutiny has become less effective. Few voters watching the news over the last couple of weeks would have any understanding as to why the Bank of England is intervening in financial markets or to what purpose, but nor have they really seen in the last decade the way in which macroprudential policy has been operated in the way that they did with interest rates. And then effective coordination. This is pre the current pandemic crisis. Clearly, after the global financial crisis, there was a return to some sense of business as usual. I would say the truth for much of the last decade is that, unlike in the previous period, monetary and fiscal policy have been working in opposite directions. And certainly in the early part of the last decade, that put too great a burden on central banks to sustain growth, when, in my view, any sensible view of the inflation target required a fiscal as well as monetary action. Anyway, all of those pressures are now intensified by the current crisis. Before I turn to current events, let me just say that I believe pre-pandemic, the Bank of England, in its independence, has already come to exposed. If the coming financial crisis, pandemic crisis, had been a more conventional financial crisis, I do think independence would be coming under pressure, because the Bank of England would be accountable for meeting an inflation target without effective interest rate tools to meet it. And because, as I said, having been granted responsibility to deliver an ill-defined financial stability goal using macroprudential tools which are poorly understood, first-order discriminatory, without sufficient Treasury engagement in that process. That's why in the last few years I've argued for two things with my co-authors at Harvard. One, in a low inflation environment, but interest rates are near the lower bound, you need some form of mechanism. We call it a fiscal open letter to allow the MPC to establish a public dialogue with the fiscal authorities when they believe that they don't have the interest rate firepower to meet the inflation target and that fiscal authorities aren't helping, but pushing in the wrong direction. And secondly, it's why we've argued that the UK needs to set up some kind of permanent FSOC style overarching body, chaired by the finance minister, the chancellor, with the bank governor, his deputies, our conduct regulator, the FCA, as full members. That body should meet regularly, should set a regular, maybe 6-monthly detailed financial stability mandate, would then legitimise the FPC, the Bank of England, in an operationally independent way, using those more controversial tools to meet a mandate explicitly set by a Chancellor-chaired FSOC-style body that would both dip the elected Chancellor and the Treasury's hands firmly in the financial stability blood and give Treasury Select Committee a proper financial stability objective to scrutinise and to be able to hold both the Treasury and the Bank of England to account for that wider financial stability objective and to look at the relationship between the two and how they work together. And I, in this seminar today, before the pandemic crisis, we're going to talk about those two reforms. But I do think that the US made the right call with FSOC, but has not given the Fed the powers. In the UK, we've given the Bank of England the powers, but there was not sufficient overarching political accountability. And my worry is that the ECB doesn't have either. And so I do think that this is unfinished business. But we are in a different world, a crisis situation, a different kind of crisis now. Some critics will claim this is a crisis in which operational independence is currently irrelevant. Of course, with interest rates already so low and a massive supply and demand shock underway, fiscal policy is going to take the lead, potentially, as we've heard from Martin and from Panikos, in potentially extraordinary ways. But I believe, and I think we saw this in the financial crisis 10 years ago, an operationally independent central bank will have a vital role to play, even in a crisis where fiscal policy is taking the lead. I do believe our governments have more real room for manoeuvre on fiscal policy because our central banks are independent and can speak out if they think governments are taking the wrong course. It was hugely helpful. The Systemic Risk Council last night, in a statement, endorsed not only radical measures for emergency financing, but legitimised the proper role of central banking, supporting Treasury to do so. It's been abundantly clear in recent weeks there is clear and effective coordination of monetary and fiscal policy going on here in the UK, symbolised by the Bank of England's decision to cut interest rates and ease credit buffers on the morning of the Chancellor's expansionary budget 10 days ago, and by Bank Governor Andrew Bailey's comments in recent days supporting the government's response, which will be authoritative, stabilising, I think hugely helpful to the government and the whole country. And as we've heard from the previous speakers, so far, this has been in contrast to the Eurozone, where a fully independent ECB, not operationally independent, first appeared to contradict the idea that national fiscal policy should legitimately take the lead, and has spent the last couple of weeks struggling to make fiscal policy in the Eurozone area functional again. The new head of the ECB has clearly been learning the hard way what effective partnership in central banking and government is, why it's vital in a crisis. I do think this is an unfinished business for the Eurozone. For now, though, in the Euro area too, the response to the pandemic crisis is now clearly owned by treasuries, with central banks part of the planning and the program. This is reassuring, but it also has dangers. In a UK context, the Bank of England now can't insulate itself from the wider strategy. At this stage of the crisis, the bank's credibility and public support is inextricably linked to the success of the government's economic response, and with the governor urging companies 2 days ago to seek financial support rather than going ahead with redundancies, the bank is clearly taking on communication of the government's wider economic message, rightly in my view. But remember my first criterion for establishing public support, central bank independence, clear and equal treatment. In the current crisis, where fiscal policy is in the lead and first-order distributional judgments are inevitable, these are rightly the decisions that should be taken by elected politicians. This is no easy place for central bankers. So far, though, clear and equal treatment is not an objective that the UK economic response to the pandemic is delivering. Yes, interest rates cuts have been non-discriminating, but loan guarantees to AAA businesses, but not necessarily to businesses mostly distressed. mortgage holiday? What about people facing rent bills they can't pay? Business rates relief, but no conditionality on the support or on wider grants, requiring companies to pass on the benefits to retain existing workers. Some groups in society, with their financial situation secure, but millions of self-employed workers seeing their livelihoods disappearing, albeit we hope temporarily, no guarantee of any financial support. I'm not saying this is easy. I know the Treasury is on the case. The fiscal bill for preserving jobs and incomes will be huge. There are difficult issues around the efficiency of spending and about potentially intervention stopping beneficial churn in the labour market. But public support for UK economic policy, including the role of the Bank of England within it, depends on the Treasury getting this right. For the last 9 years, active fiscal policy has been downplayed. Now it has to step up massively. Distributional issues have been downplayed. This time, the government is going to have to truly say we're all in it together. In my view,
we slowly have to move to Q&A.
This is my final paragraph. In my view, without direct support which gives similar security to people who work in small businesses, the young and self-employed, as it does to large companies, the vulnerable, retired and public service, then we could see a backlash against our institutions of economic policy, including our central bankers, who are now at the heart of it. And I think that would be very risky for our future. Thank you very much indeed. Sorry for going on a bit too long, Catherine.